Deadwood, Dakota Territory, 1878. Gold, freight, merchants, and speculation are pulling money into a frontier town that barely existed a few years earlier. You have $50,000 of shareholder capital behind a new business, the First National Bank of Deadwood. Customers bring money to your counter. Merchants need credit. Dollars move through the books every day. From the outside, this looks like one of the easiest ways to become rich in the West. Except for one problem. The money customers deposit is not your money. The bank owes it back to them. That changes the entire question. A banker's wealth cannot be measured by counting the dollars behind the counter. Depositors have claims. Borrowers owe money back. Losses fall somewhere, and only what remains belongs economically to the owners. So could owning a bank in a Wild West gold town actually make you rich? To answer that, we have to find out what a frontier bank was really selling. The First National Bank of Deadwood was organized on September 1, 1878, replacing the earlier banking house of Stebbins, Wood and Post. This was not an improvised frontier money shop. It was a federally chartered national bank operating inside the national banking system created during the Civil War era. L.R. Graves served as president. Samuel N. Wood was cashier and manager. Historical biographical evidence also identifies Wood as the principal stockholder. That combination matters. Wood was not simply keeping somebody else's books. He was helping run the institution while his own ownership stake was exposed to its success or failure. The bank operated at the corner of Main and Lee Streets, inside Deadwood's commercial center. Its records also identify Counts Brothers as a correspondent. That small detail reaches far beyond the building. A bank sitting in a western mining town could still be connected to financial institutions elsewhere. But there is an important limit to what survives. We do not have a complete annual profit and loss ledger for the First National Bank during the years we are studying. We cannot simply open an account book and read off Wood's annual return. So the investigation has to work differently. We can reconstruct how the business functioned without inventing profits the historical record does not give us. Start at the teller's counter. A customer deposits cash. The bank now has more cash available, but it has also created a liability. The customer has a claim and expects to receive that money again. The historical directory names H.Y. Ainley as teller and Alvin Fox as discount clerk, while Wood served as cashier and manager. That staffing tells us something about the operation. Money did not simply enter a safe and sit there. Some of it moved toward credit. At the discount desk, the bank could exchange cash for a promise of future payment. A borrower received funds. The bank received a loan or note that could earn a return. On the balance sheet, both cash and a performing loan are assets. In practice, they behave very differently. Cash can satisfy a withdrawal today. A loan due weeks or months from now may not. That tension sits at the center of banking. The ledger keeps track of who deposited money, who borrowed it, when obligations come due, and how much value the institution still controls. Then the correspondent relationship extends that system beyond Deadwood. So this frontier bank was always balancing two jobs. It had to put money to work, and it had to keep enough money available. Credit could create earnings. Liquidity kept the doors open. The First National Bank was listed with $50,000 of capital in 1879. That is the figure that belongs at the center of the ownership story. It was shareholder capital. It was not the same thing as customer deposits. Once the bank begins operating, three categories must remain separate. First, shareholder capital, the owner's stake. Second, liabilities, money, and other obligations the bank owes. Third, assets, cash, loans, government securities, correspondent balances, and other financial claims. Mix those categories together, and a bank can look much richer than its owners really are. National banks could also issue national bank notes, but those notes were not money created without cost. U.S. government bonds stood behind that circulation under the national banking system. Liquidity rules mattered for the same reason. A bank could not safely lend every available dollar and assume nobody would ask for cash. A later historical account from 1884 reported the First National Bank of Deadwood with stated capital of $100,000, compared with the earlier $50,000 figure. That points toward expansion, but the surviving evidence used here does not tell us exactly when the increase occurred or what caused it. Nor do we have precise figures for the cost of the premises, safe, furniture, salaries, or every other operating expense. Those gaps stay gaps. The important distinction survives without filling them. How much money passes through your bank is one question. How much of the institution you actually own is another. A bank's inputs look different from those of a mine, bakery, or cattle operation. It needs capital, cash, reliable records, credit-worthy borrowers, good information, and connections to the financial system outside town. It also needs people. Wood managed the bank. Ainley worked as teller. Fox handled the discount function. Their exact salaries are not established in the evidence we are using, so there is no responsible reason to invent them. But their jobs tell us where the work was. Deposits had to be recorded. Withdrawals had to be paid. Loans had to be judged. Notes had to be tracked. Accounts had to balance. And behind all of those activities was one uncomfortable trade-off. Cash is useful because it is liquid. A depositor can ask for it. The bank can pay a bill with it. But money sitting idle does not produce the same return as money placed into a performing loan. Lending more can increase earning assets. It can also reduce the cash immediately available. Hold too much cash, and the bank sacrifices potential income. Push too much money into loans, and the bank becomes vulnerable if customers suddenly demand cash. Then there is credit loss. A loan does not become dangerous only when somebody officially declares default. The problem can start earlier. A borrower's business weakens. A payment arrives late. Another obligation is missed. An asset that still appears in the bank's books may no longer be worth what the bank expected. In a town whose commercial life was closely tied to mining and the businesses around it, weakness could move from customers to borrowers and then into the loan book. At the same moment, cautious depositors might want more cash rather than less. That creates a nasty combination. Cash inflow slows. Cash outflow rises. The bank can appear valuable on paper while becoming less able to pay today. For this business, one of the most dangerous expenses does not arrive as a bill. It arrives as money that was supposed to come back and does not. The obvious source of bank revenue is credit. A customer needs capital. The bank advances funds. In return, the borrower owes repayment plus an agreed financial return. That part is easy to understand. The difficulty comes afterward. A high interest rate does not automatically make a loan profitable. If the borrower fails, the bank can lose far more than the interest it expected to receive. Even a good loan can create a timing problem. Suppose the borrower is perfectly capable of paying next month. That does not help much if depositors demand cash this morning. So every interest-earning asset forces the banker to think about two things at once. Will this borrower pay? And will the bank still have enough liquidity before that payment arrives? Interest matters. But interest alone does not explain why a frontier bank could become such a valuable institution. For that, we have to follow the customer beyond a single loan. A competing Deadwood banking house, Brown & Thumb, advertised drafts usable across the United States and Europe, interest on time deposits, telegraphic money transfers, collections, advances on ores and bullion, trading in public securities, and purchases of gold dust. That advertisement is comparison evidence. It does not prove that First National offered every one of those services in exactly the same way. What it does reveal is the kind of financial market operating around the bank. A customer did not always need coins. Sometimes the real need was movement. A merchant could need value transferred outside Deadwood. Someone could need a collection handled. A participant in the mining economy could need financing connected to ore or bullion. A customer with local wealth might need a financial claim that worked far beyond the Black Hills. That changes the relationship between bank and customer. One customer could bring more than one economic opportunity. A merchant who kept funds at a bank might also require credit, settlement, a draft, or a collection. The value was no longer confined to the interest on a single loan. It was in the relationship. And now the correspondent connection matters. Counts Brothers was listed as the first national bank's correspondent. Wood had already worked in banking in Colorado before coming to Deadwood, including within a Counts-related banking institution. That does not prove Counts Brothers financed every transaction at First National. It does not prove they rescued it during a crisis. But it does establish something more basic and more important. The bank was connected. Deadwood might be a frontier mining town, but its bank did not have to function as a financial island. The vault stored money. The network made the bank useful. Once that network exists, information becomes valuable too. Credit requires judgment. Which merchant can repay? Which note is sound? Which customer is becoming risky? Which business is weakening before its debts actually fail? A bank operating inside a small commercial community can accumulate knowledge about the people asking it for money. But that information has value only if the bank itself remains trusted. Depositors have to believe their funds are available. Borrowers have to believe credit will be there. Other financial institutions have to believe the bank will honor its obligations. The product, then, is larger than money. The bank is selling credit judgment, liquidity, financial access, and trust. Those things can make the institution valuable. They also give it more ways to fail. Every banking opportunity produces an obligation. Deposits provide funds. They also create claims that customers can demand back. For country national banks in this period, reserve requirements tied to deposit liabilities were 15%. The point was straightforward. Some financial resources had to remain available rather than being pushed entirely into earning assets. Loans create interest income. They also create credit risk. National banknotes can circulate under the bank's name. They also come with federal rules and government bond collateral behind the system. Then there is the shareholder. National bank shareholders in this era faced what became known as double liability. In a failure, an owner could lose the investment already made in shares and could also face an additional assessment up to their par value. That places the shareholder in a very different position from the customer at the counter. The depositor has a claim against the bank. The borrower owes the bank. The shareholder stands behind what is left. That makes one of the great images of the Western misleading. The armed robber at the teller window is easy to see. A deteriorating loan book is much quieter, and it can reach the owner's capital directly. Credit risk comes first. Borrowers can pay late. Some may fail completely. Expected interest disappears, and part of the principal may disappear with it. Then comes liquidity. A loan may still have value and yet be almost useless for satisfying a withdrawal today. Then comes confidence. Once depositors or other counterparties become less certain about the bank, demand for cash can rise. The institution now needs more liquidity at exactly the moment people are least willing to wait. Deadwood adds another layer, concentration. Mining and the trade surrounding it played a major role in the local economy. We cannot claim that one documented mining downturn caused a failure at First National during these years. But the business mechanism is clear. If local commercial activity weakens, borrowers can weaken together. That makes diversification harder. Physical risk was real as well. On September 26, 1879, a major fire devastated much of Deadwood's business district. The surviving evidence used here does not establish a precise dollar loss for First National, so there is no reason to invent one. The fire still demonstrates the environment in which this bank operated. Even the commercial core of the town could disappear with extraordinary speed. Now connect the financial risks. Businesses weaken. Some borrowers struggle. Loan repayments slow. The bank receives less cash than expected. Depositors become cautious and ask for more money back. Liquid resources shrink. The bank has to collect loans, sell liquid assets, or rely more heavily on outside financial relationships. If confidence weakens further, the pressure begins feeding itself. Losses move toward shareholder capital. The critical variable is not how many bandits are riding toward town. It is whether money owed to the bank arrives before money owed by the bank has to leave. There is no complete annual account in our evidence that tells us exactly what First National earned in 1879, 1880, or 1881. So the financial reconstruction has a narrower purpose. It tests the mechanism. Keep the documented $50,000 of early shareholder capital in mind. Then use a simple unit, $100 of deposits. That $100 is a reconstruction assumption, not a claim about First National's actual deposit total. In a strong environment, withdrawals are manageable and borrowers pay as expected. The bank can keep a liquidity cushion while placing some financial resources into earning assets. Interest comes in. Credit losses remain limited. Shareholder capital is not being consumed to cover problems. Move to an ordinary environment. Some borrowers pay late. Withdrawals increase. The bank may still hold valuable assets, but its immediate cash cushion is smaller. Nothing has to be insolvent for the situation to become less comfortable. Timing begins to matter more. Now move to a weak environment. Several borrowers struggle at the same time. Some loans become doubtful. Depositors also want more cash. The books can still show loans with face value. The teller cannot pay withdrawals with face value. Cash is needed. Today, a loan due next month may eventually be good, but eventually is not the same thing as liquid. This is where reserves, liquid securities, correspondent balances, and shareholder capital become critical. The reconstructions does not need an invented annual profit figure to reveal the problem. Profitability and liquidity are different tests. A bank can hold interest-earning assets and still face a cash crisis. And because deposits are liabilities while losses ultimately reduce the asset side and equity, deterioration in the loan book can hit the shareholder harder than the initial bad loan number suggests. The strong environment rewards the decision to put money to work. The weak environment punishes the same strategy when cash is needed faster than assets can return it. That leaves the final question. Did a real owner turn this banking position into durable wealth? Samuel N. Wood stayed in Deadwood for roughly 3 years. Historical biographical evidence says he sold his banking interest, returned to Denver, and later acquired a controlling interest in another bank. That sequence needs to be handled carefully. It does not prove that First National Bank of Deadwood, by itself, made Wood rich. We do not have the price at which he sold his interest. We do not have a complete dividend record. And we do not have the annual profit figures needed to separate the contribution of this bank from the rest of his later financial success. But we do know the progression. Wood entered Deadwood with banking experience. He helped organize a national bank. He became its cashier and manager while holding a principal ownership position. Then he sold that position and later moved into controlling ownership of another financial institution. That is a much more useful picture of wealth than a pile of cash behind a counter. A banking business can create operating income. Ownership can create an asset that may later be sold or reinvested. Experience and financial relationships can create access to opportunities beyond the original institution. Those categories are related. They are not the same thing. So, could owning a bank in a Wild West gold town make you rich? Yes, it could. But the path depended on good credit decisions, sufficient liquidity, continued trust, and the ability to turn successful banking ownership into durable financial value. The risk traveled in the opposite direction. Deposits remained obligations. Loans could deteriorate. Cash could become scarce. And the shareholders' own capital stood behind the institution, with the additional liability rules of the national banking system, making failure even more serious. We began with a vault. From the street, that vault looked like the obvious source of the banker's wealth. It wasn't. A full vault could make a banker look rich. A sound balance sheet was what could actually make him wealthy.